Hello everyone, welcome to today's session. So today we are going to continue our discussion on the chapter number 14. We will take up some questions on the chapter number 14 unit 2 first, so that we can just do a refresher of the unit 2 and then we will shift to the unit 1. Okay, so let's before I jump and deep dive into the chapter number 14 unit 2, okay, on the question side, any doubts you guys have? Any doubt? If you have, you can write in chat box, or you can try to unmute if you can. Otherwise, you can write in chat box and ask your doubts. No? No doubts? Okay, not an issue. What we will do is we will take up some questions. Okay, we will discuss these questions, how to write the answer, and then on the basis of that, we will proceed ahead and we will basically discuss the answer of that particular question based on whatever we have discussed. Okay, so we'll start with the questions which are given in the study material itself. Test your knowledge, and we'll see how in front of the amendments how these questions stand and what will be their answer. So the first question, pretty much easy and pretty much straightforward. Shubham and associates are going to start the audit of NBFCs. They have not performed much work for the NBFCs in the past year. You are required to explain the requirement related to the registration and regulation of the NBFCs, which an auditor needs to keep in mind while planning the audit of NBFC, which would help this firm. Simple. You need to explain the requirements related to the registration and regulation of NBFCs. Simple. So now, if this question is there, what answer you will write? Anyone? What answer you will write if this is the question that you are getting over here? No? We'll explain 50-50. Yes, very good, Kanaya. What else? Anything else you would like to add or you would explain in this? Anything else? Certificate of registration, yes. So basically, when we will start writing the answer of this particular question, we will start with section 45 IA, which requires registration, that is certificate of registration, COR. Okay, and that requires the NOF requirement based on the funds that you are required to maintain. Then we will go to the regulation. We will define scales, scale-based regulation, that BL, upper layer and everything. Okay, that is how they are regulated. Plus, if you want, you can also define about the exemption which is there. Okay, so this is how straightforward you need to write the answer. Starting from registration, let's go and quickly revise what will be the registration. Okay, so what we discussed in the registration, that section 45 IA. Okay, and then on the basis of that, we will decide what is the requirement over there. Then we will go and we will explain the scale-based regulation with the base layer. Okay, these NBFCs are divided in this layer system. Then on the basis of that, we will also discuss about the 50-50, that when we are discussing the section 45 IA, we will discuss the principal business criteria. Okay, after that, after I discuss everything and the principal business criteria, then I would be discussing about exemption which is given to the unregistered type 1 registered NBFC and that particular part. This is how I will explain the registration and the regulation requirement for the NBFC. pretty much straightforward, no complexities. Clear to this? Any doubt? Yes, no? Okay. Let's see one more question. These are the kind of, a revision question you can understand. Satyam Private Limited is a company engaged in trading activities. It also made investment in the shares of other companies and advanced loans to the group companies, amounting to more than sorry, I'm really sorry, amounting to more than 50% of its total asset. However, trading income constitutes majority of total income, whether the company is an NBFC. So, in this question, do you think the NBFC is this particular company is an NBFC? And how will you write the answer? Simple. Its answer is pretty straightforward. That when I talk about NBFC, you need to specify that in order for the company to be classified as an NBFC, they need to have that 50% of the total asset should be financial assets, and the income from financial assets constitute more than 50%. Then only in the given case, they do not fulfill the criteria of income side. Hence, they are not the NBFCs. Simple. The 50-50 criteria we are talking about over here. Both rules must be satisfied. Okay. Now, next question I will ask you. Okay, a separate question apart from everything that we have discussed. Okay, so just let's go and discuss a important question that will help us a great revision of the topic. The question is, ABC Private Limited, okay, is involved in investing in shares of group companies. Okay, the total asset for financial year 24-25 is rupees 600 crores. The company only invests and does not accept deposits. The auditor of ABC Private Limited has raised a query that the company must obtain COR, okay, under section 45 IA of RBI Act. The company only has dividend as its entire income. Okay, so this is the question. Now you need to comment on this. Simple. So the company has 6,000 crores or 600 crores of total asset, which is only investing in shares of group companies. The company has only dividend as its entire income, nothing else. Now the auditor, okay, is saying that the company must obtain COR under section 45 IAF of the RBI Act. You need to comment on this. Now tell me, what is the outcome of this? As an auditor, whether auditor is right, or as a management has not obtained the COR. Okay, to specify that management is not agreeing to obtain COR under section 45 IA. Simple. Now tell me, what do you think? Who is correct, management or the auditor? My question is that, first of all, evaluate the criteria of the NBFC. So what is the NBFC's criteria? In order to classify a particular company as NBFC, what is the criteria? What is the criteria? If I have to classify a particular company as an NBFC, what is the criteria? Anyone? Very good, Kanaya. Samanathan, just understand what criteria is important over here with respect to the NBFC. See, when I talk about NBFC, they are required to obtain registration if they fall under, if they, meet certain criteria. We need to evaluate from that criteria. Now tell me, under this particular question, do you think they are required to take the registration? Yes, no? So we need to evaluate whether the registration is required or not based on the regulation, based on whatever we have discussed till now. And that's where, the application of the provision will come into the picture. Okay. So under RBI Act, who is required to obtain registration? Anyone? Under RBI Act, who is required to obtain registration? Which company must obtain the registration under RBI Act? Don't say me NBFC, but we need to say what provisions make them, obtain the registration. So which is the particular activity for, if a company does, they fall under the category of the, requirement under the RBI Act. What are those categories? We have discussed that. We have discussed those sections also. Quickly. Under which category or which activities, if a company performs, they are required to get themselves registered under the RBI Act? 50-50 test. Okay, yes. But before 50-50 test, understand one thing, that there is something more also. Like, there is a, yes, we discussed the 50-50 test. That was there. But apart from the 50-50 test, we also discussed about that there are certain, activities. If a particular NBFC performs those activities, a particular company performs those activities, then we will go to the next step is the 50-50. Yes, very good, Samanathan. Absolutely correct. And those are discussed in section 45I, okay, of the RBI Act. 45I of the RBI Act. And let's see 45I of the RBI Act. Again, quickly, so that we can understand. See what section 45I is, definitions. Over there, we talked about business of non-banking corporation, business of non-banking financial institution, which is as per C and F. And if we go to C, basically, financial institution means non-banking institution. Okay. Its business or part of business is acquisition of shares, bond, securities issued by a government, local authority, or other marketable securities. Or if you go to the F, non-banking financial company, a financial institution, non-banking institution, lending or deposit, it will not come under this particular part. but it is a financial institution already that we have discussed. Okay. Under C, we have discussed financial institution means acquisition of shares. So the company is investing in the group company means acquiring the shares. Okay. And as a result, if a particular company which has a business or part of business, now here we have 50-50 criteria to understand. Okay. And then based on that, we need to understand whether this company is a NBFC or not. So if it is a business of non-banking financial institution, okay, business of non-banking, then in that case, they are required to get registration. Now let's go back to our question. Investment, you will say, sir, yes, this falls under the section 45I, you can say C and F, okay, and which gives the registration 50-50 criteria, which is also being satisfied. So this criteria is also being satisfied. This criteria is also being satisfied. As a result, you will say registration required. Yes or no? You will say registration required, but the answer is no. But the answer is no. Now tell me why. Why the registration is not required? See, 45IC and 45IF are applicable. 50-50 test is applicable. That is being satisfied. Still, I'm saying registration not required. Why? What is the reason for that? Anyone? Why the registration is not required even when the satisfy the criteria of the ICF 50-50 both? Very good, Kanaya. Remember the exemption. Asset size less than 1,000 crores. No public funds. No customer interface. If these conditions are satisfied, then you have the exemption. And as per the exemption, you are not required to get registered. Simple. So this NBFC will fall under the category of unregistered type 1. As a result, registration not required. And that is what you need to write in the answer. That as per the provisions, if a NBFC has a less than 1,000 crores, not availing public funds, not having customer interface, even when they satisfy the criteria of 50-50 plus even they satisfy the criteria of section 45I, C and F, they are not required to get registered. Simple. Clear with this? Any doubt? So that's where the registration and exemptions come into the picture, and they are very important. They are very important. Okay. So now let's take one more question, very important one, and then, okay, we would have a good understanding of this particular regulations. The question is, You are appointed as an auditor of NBFC registered with the RBI and which is accepting and holding public deposits. You are considering your reporting requirements in addition to report made under Section 143 of the Companies Act on the accounts of this NBFC as per the prescribed direction. Please explain what points are required to be known in respect of the separate report to be given to the board of directors of this NBFC. Now we are talking about reporting part. Tell me what are the points that basically you should be knowing. Now, what is the requirement is what points are required to be known in respect of the separate reports. So you need to explain those points of the separate report. Tell me, what are those points of separate report? Anyone? The points of those separate report. Now, okay, before we go into the separate report, a quick question. In how many parts the separate report that is being discussed in this question is divided into? How many parts are there? Anyone? How many parts are there in the separate report? No? Let us go and discuss the separate report. Yeah. This is what the separate report is. Auditor's Report Direction 2026. Remember, they are divided into 4 parts. First part applicable to all NBFC. Part B applicable to accepting public deposits. Part C not accepting to public deposits. Part D exemption. So we are talking about in our question part B accepting public deposits. When I talk about accepting public deposits, over there part B talks about from here the deposits, like form of deposit, in which form you have accepted the deposits. Okay. Regularization of the excess deposits, minimum credit rating. Okay. Whether it is from SEBI CRA, aggregate amount exceeding the limit has been accepted or not, violation of any restriction, default by NBFC, capital, risk ratios, risk weighted asset ratios, income recognition and asset classification and provisioning norms compliance. Okay. Then liquid asset reporting. Then your reporting on deposits, return on deposits. Okay. Then again, your prudential norms or prudential parameters. Reporting. And then branches, opening of new branches. So these are the points which are required to be known and considered when you are going to prepare the separate report which will be submitted to the board of directors. Clear? Any doubt on this? Any doubt? Okay. If no doubt, so that was a understanding of the chapter 14 unit 2. Okay. Plus one more thing I would like to discuss is schedule 3. See, schedule 3 is applicable basically to the NBFCs, and there is one point that I want to discuss with respect to the related party. So there are a few changes that are required to be reported, and that will be applicable from next year onwards. Okay. Now, what are these changes which are applicable from 1st April 2026 with respect to the related party exposure? Basically, there is a separate disclosure now required in the financial statements. Disclosure in the financial statement is required with respect to the exposure to the related parties. Okay. Now, what details are required to be given in that particular separate disclosure in the notes to account? Number one, aggregate value of the loan sanctioned to related party. So, loan sanctioned. Second, aggregate value of outstanding loan as on 31st March. So one is the loan given, second is the or sanction, second is the outstanding loan. Third, aggregate value of the loan outstanding to related party as a proportionate to total exposure. So total credit exposure. So in that, how much is the loan given to the related party? So that means you need to take out the percentage outstanding loan divided by total credit. Okay, into 100. So whatever percentage will come, that you need to report. Then aggregate value of the outstanding loan to related parties categorized as a SMA and NPA. So you need to bifurcate this particular outstanding loan into SMA and NPA. Then aggregate value of contracts and arrangement awarded to related parties, and aggregate value of outstanding contracts and arrangement involving related parties. So one is the contracts and arrangement awarded, and second is outstanding contracts. How much is the outstanding on those contracts? Outstanding value of contracts with related party. So these are certain disclosures that are required to be given for the purpose of related party transaction, and that is applicable from financial statement 1st April 2026. Okay. So whatever financial statement will be prepared from 1st April 2026, these requirements will be adhered to. So each and every NBFC is required to basically fulfill this disclosure requirement. So very important update. Very important. Apart from this, basically your Schedule 3 Division 3 is applicable to the NBFC. Okay. Schedule 3 Division 3 is applicable. When I talk about Schedule 3 Division 3, let me explain or let me show you one important thing in that. See, when I talk about Division 3, okay, of Schedule 3, we need to understand how it is different from the rest of the divisions, and how a detailed disclosure is required. A bit of change is required. I just take you overview of that. So this is applicable to the financial statement for a NBFC whose financial statement are drawn in compliance with the company's Ind AS rules. So Ind AS is applicable, and on the basis of that, this disclosure or this Division 3 is required to be followed. Okay. Now again, this is in addition, not in substitution to the disclosure requirement specified in the Ind AS or in any regulation. Okay. So regulation, if regulation says provide additional disclosure, then you are required to provide that additional disclosure. Okay. Now, again, simple point, rounding off. If total income is less than 100 crore to the nearest 100,000 lakhs millions, you need to round off. And very important, This has been changed. Now it is shall be. So it is a mandatory round off, not a maybe. Okay. Second, that when the balance sheet is prepared, I'll just highlight few important parts. Is first is the financial assets. Unlike the non-current asset, okay, we start with the financial asset in the balance sheet. Okay, so first category of financial asset, because this is where we talk about, remember, 50-50. So 50% should be financial asset, principal business criteria. Remember? This financial asset is something we consider for the 50-50, principal business criteria, which includes your cash, bank, derivatives, receivables, loans, investment, and financial asset. And this is in the, descending order of liquidity. That means higher the liquidity or higher the liquid asset, they will be, they will be quoted first. So this is entirely liquid. Okay, so the more the liquid, they will be reported first compared to the assets which are quoted below. So based on the liquidity, they are mentioned. So highest liquidity, that's why the cash is on the top. Same, after that we get the non-financial asset, which includes your inventories, current assets, current tax asset, deferred tax, investment property, biological, plant property, capital work in progress, intangible, goodwills, other intangibles, and other non-financial, which is required to be specified. Similar with the first financial liabilities, which include derivative financial instruments, payables, then debt securities, borrowings, deposits, subordinate liabilities, and other financial liabilities, and then non-financial liabilities. And in last, you have a equity. Okay. Then when we talk about the P&L, like just let me show you. We will not go into the each and every schedule or disclosure, but one important one is the profit and loss account statement that I want to discuss. Is again, we start with the income which are related to the NBFC. So revenue from operations will now will include interest, dividend, rental, fees, commission income, all these things like which are relevant to the NBFC. We talk about income from the financial assets. Okay, then you get the other incomes, expenditures, the way it is, and then your profit and loss account, rest of the things will be there. Rest is on the similar lines, the way you have seen, rest of the disclosures in the rest of the division. But this is how you are required to report or, prepare the two main aspects of the balance sheet and P&L. One on the liquidity side. Second, now the interest and dividend is part of your revenue from operations. Clear? Any doubt? Any doubt? See, this is very important to understand because based on this, your financial statement basics is prepared. Like, this is the basic of the financial statement for the NBFC. Then only you will be able to understand the, why they are drafted in such a way. Okay, so that is your unit 2. Any doubt till now? Any doubt? Any doubt? No? Okay. If no doubts, let us now proceed to unit number 1, which is the audit of banks. Okay. Now, what we have understood in the NBFC, trust me, we will replicate the same in the audit of banks. Okay. Why? Because it is the same concept. Like, the purpose of these amendments that you are seeing in the NBFC is because they wanted to align the entire regulation framework on the lines of banks. So instead of keeping two different frameworks, they tried to align everything with one single framework, like to bring as much as closer to the regulations which are applicable to the bank. And let me show you how. First of all, I'll provide you some brief background about the NBS bank regulations. See, this is the RBI website on your screen. Okay. Now, basically, if you see this RBI website, we were now discussing on the part of regulation, and we were discussing on the non-banking financial companies. Now we will go to the commercial banks. And the way it is being structured, yes, banks are highly regulated compared to the NBFCs, but it is structured in the same way. On the 28th November 2025, the regulations were also changed for the banks. And similarly, now see, first of all, banks doesn't require registration. They require licensing. The licensing is required. So Reserve Bank has brought universal bank licensing guidelines instead of registration. So now it is not registration. No one can, start a company and get the registration as a bank. No, you need to obtain the license of the bank, which is more regulated, more difficult. We'll not go into that. But if you see prudential norms on capital adequacy, the way we had in NBFC. Similarly, if I talk about classification, classification, valuation, and operation of an investment portfolio. Similarly, we had in the NBFC also. Then income recognition and asset classification, we had in NBFC also. Financial statement and presentation disclosure, we had in NBFC also. After that, if I talk about further, there were, again, different set of regulations, that is asset classification, provisioning, and income recognition in 2026, which is the newer version which was introduced with some more changes. Okay, and they are effective from 1st April 2027. And similarly, all these things are applicable the way we have discussed. For example, I'll just show you something, some classifications which are there over here. See, if I talk about income recognition, okay, so income recognition, how it is required to be done. Then after that, classification of various type of products which is there. Now for bank, there is a ECL requirement, upgradation of accounts. Same we had in the in NBFCs also, that when you can upgrade the accounts. We will go in detail. I'm just taking you a overview of the entire set of regulations which is there. Then again, standard, substandard asset, doubtful asset, loss asset. Okay, the way we had in the NBFC. Okay, classification of the NPA. Okay, so similar lines. So what RBI did is RBI tried to bring everything like the NBFC as much closer as possible to the banking regulations and the direction which are there to the banks. Yes, banks are much more regulated. They are regulated on a higher level compared to the NBFC. So you will see more regulations when we are talking about banks. But having said that, a lot of concept that we have understood in the NBFC will be carried forward over here also. Now, second, banking. When we talk about bank, you already studied about balance sheet, P&L, and all these things in the inter level. So from where they are coming, that is very important to understand. So there is a direction called Commercial Bank Financial Statement Presentation and Disclosure Direction. Over there, you have the directions how you need to basically draft your balance sheet, P&L of the bank. Okay, so what are the things you are required to include in the balance sheet, into the notes to accounts, everything with respect to a bank. Okay, all the disclosures that are required to be made, how you are required to make, everything is discussed in these regulations. And from here, they come and you are required to prepare the financial statement accordingly. Then income recognition, asset classification. We saw this one also, the updated version. Okay, which is applicable from first. The new one is applicable from 1st April 2027. This was applicable from like 1st April 2026, and the new version with change, with change version came from 1st April 2027 with some changes. Then capital adequacy. Now, if I show you capital adequacy, we have seen something already called common equity tier. Yes or no? So similarly, we have in this also in our banks tier 1 capital ratio, capital CRAR ratio, capital to risk weighted asset ratios. Similarly, we have seen in the NBFC, it is applicable over here also. So these are being carry forwarded. The concept is the same. The calculation might differ. We will see that, but the concept is the same. Okay. What things are required to be included in tier 1, tier 2, then CET1. Banks have CET1 also accordingly. I'm just showing you how the entire banking regulation scenario works. Okay. This is how the entire banking scenario regulation, is there. And based on that, we will discuss our unit 1. We will discuss various topics of the unit 1. Clear? Any doubt before we jump and proceed and discuss the unit 1? Any doubt? Yes, no? No doubts? Okay. If no doubts, then let's discuss, basically unit 1. That is the special feature of audit of banks. Okay. We are done with the NBFC. Now we are jumping to the banks. So when we are talking about bank, what we are talking about and what we will discuss is the regulatory framework, first of all. Then we will discuss the form and content of financial statements. Then we will discuss the audit of accounts, auditor report, conducting an audit, internal controls, verification, which is assets and liabilities. Okay. And then concurrent audit and audit committee. This is something how we will plan and we will discuss these topics. Okay. First of all, let's start discussion with the first very important part, that is the regulatory framework. Can anyone tell me which is the main regulation that is applicable to the bank? The important and the prime regulation that is applicable to a bank. One important regulation that is applicable to a bank. Anyone? Banking Regulation Act. Yes, very good. Banking Regulation Act is the first and the important act which is applicable, okay, to the banks, and based on these regulations, banks are the one. Simple. So banking regulation is the regulation which is applicable to the banks. Apart from the, yes, some portion of the RBI regulation is also applicable, but banking regulation is that particular regulation which is applicable to banks, and majority of the things are being governed from that particular regulation. Okay, and that has been amended multiple times. Okay, and accordingly, the amended version is there of the Banking Regulation Act, which is applicable to the banks. Okay, now that is the first regulation that is applicable to a bank. Can anyone tell me other laws or regulations that is applicable to the bank? Okay, SBI Act, fine, because it is applicable to a specific SBI company. Okay, SBI Bank, sorry. So SBI Act. Any other act? Companies Act, very good, yes. Any other act? PMLA, yes, very good. RBI, yes, very good. Anything? Let me show you the list of laws or regulations that are directly or indirectly applicable to a bank. Okay. So these are the act and regulations which are applicable to the bank. African development, it is to the specific companies and to the specific banks. There's a Banker Book Evidence Act. One important note, this act is being, introduced, like there is a new version of this act which is being passed in the parliament right now. Bankers Book Evidence. Okay. Banking company acquisition and transfer of undertaking. There are two versions of that. Banking regulation, banning on unregulated deposit scheme act, bilateral netting of qualified, black money, coinage, credit information companies act, deposit insurance, exim bank, factoring regulations. A lot of regulations are there which are applicable to bank. Okay. Regional rural banks, recovery of debt, public debt, securitization, SARFAESI, okay, SIDB, specified bank notes, state bank applicable to SBI, okay, and then MSME, legal tender, a lot of things are there. A lot of things. So it is also already given on the RBI's website, which is a legal framework. You can go into the legal framework, you can go into the acts, you will get all the acts, which is applicable to the banks. Okay, so there is not a single particular one act or a regulation. There are multiple acts or regulation which are applicable to the bank. Okay, so we have seen this legal framework. Now, why it is important for us to understand the legal framework? Because based on this legal framework, you will be able to now, when you are performing the audit, there is one standard we have discussed in the past also. There is one standard which talks about that. Okay, when you are auditing a particular company, you need to think of the laws and regulations. Can you tell me which that standard is? Which that standard is? Which talks about, okay, think of the particular law or regulation in the case of the audit. Anyone? Which is that standard? No, Samaynathan. A standard on auditing which talks about that this is a particular standard that you should consider laws and regulations. Yes, very good. SA 250. We already discussed. Yes or no? SA 250 is something that you need to, it says that consider the law and regulation in case of an audit. And that's where the term, these things come into the picture, that these laws and regulations are required to be understood. Okay, let's understand Banking Regulation Act, the first and the prime, very important law that is applicable to the bank. Now, what is the important point that we need to understand from the Banking Regulation Act? There are multiple aspects that we will take up and we will understand from the Banking Regulation Act. But the first and important thing that we need to understand is the form and content of the financial statement. Form and content of the financial statements. Why? Reason, because the form and content is very important. That is a financial reporting framework. So from there, this particular thing is coming, that what is the form and content of the the financial statement that the bank is required to prepare, in which they are required to prepare. We saw the directions. Apart from the directions, there is this act also which provides the form and content. Okay. Now, what is that in the act? Let me show you. Basically, in this particular act, there is something called just a minute. We will go, and there is something called schedule 1, 2, 3. Now these schedules are very important to understand, because here the important detail is covered. Let's go to these schedules. Okay. Now, in third schedule of the Banking Regulation Act, okay, the first schedule, basically when I talk about, it is the amendments which are there, the first schedule. The second schedule was repealed, and the third schedule is where your entire Form A of the balance sheet and P&L lies. Remember, schedule 1 and the third schedule are different. Third schedule is basically the schedule where your entire Form A and balance sheet is lying. Okay, and in that you have the multiple schedules that you have already understood at the intel level. I'm just telling you where they are. Okay, so your Form A and Form B is in the third schedule, which may include your multiple schedules like Schedule 8 investment, whatever you have understood. I'll not go into that detail because that is already covered. Okay. Now, when I talk about this particular part, this third schedule, that is coming from Section 29. Section 29 of the Banking Regulation Act, which requires banks to prepare in a specified way, like the financial statements in a specified way, which is given in the third schedule, plus any other information or any other detail that they are required to maintain in their financial statement, which is given in the regulations. Okay, so let us see quickly Section 29 of the Banking Regulation Act, which talks about accounts and balance sheet. If I talk about that at the this particular part, okay, so basically every bank is required to prepare the financial statement as per the the form prescribed in this particular schedule, so which is set out in the schedules which are given in this particular act. Under that they are required to prepare the financial statement. However, okay, government may from time to time notification amend the form set out in the third schedule. That means there are other things that the government can bring into to amend the third schedule apart from all the things which is there in the third schedule, like the P&L and balance sheet. Okay, so apart from that there could be additional things also which the government may think they can bring into, and that's where it becomes very important that there are regulations prescribed also where these financial statements are required to be prepared third schedule plus those regulations. So let me show you quickly. So these were the directions that we were talking about. Commercial banks, financial statement, presentation, disclosure directions. Okay. If you see a simple thing, if I talk about, these are under the power of 35A of the Banking Regulation Act. Again, the same, 35A also empowers to issue the directions, which is there in the public interest. And these are the directions which are required to be followed by the, banks with respect to the presentation and disclosure, which is Section 29 says form and content of the balance sheet. Okay, the format of the balance sheet, which is there in the third schedule, again, which is also there reproduced in the annexure 1. Plus, apart from that, these are the general instructions that the bank should follow when they are preparing the financial statement. Instruction for the compilation of the balance sheet, and they have provided area-wise instructions. This is over and above your third schedule. Okay, and this is an exercise of the power of Section 29(4), the section we saw. As a result, when a bank prepares a financial statement and an auditor audits the financial statement, not only the third schedule is required to be followed, you are also required to see whether the bank has complied with these directions or not. We will take up these directions area-wise area rather than going into one entire set. But just remember, This is from where the direction comes into the place. Okay. Now that was the form and content of the audit balance sheet for the banks. Okay. Now comes the second and important very aspect is that when we are talking about the audit of banks, our topic is the audit of banks. We need to understand from the point of view of appointment till the audit. We need to cover from the appointment till the audit, like how banks, audit of banks works from the appointment till you issue the report. Okay, so let us see. Now tell me one thing, when you talk about appointment of the auditor in case of the banks, how the appointment is done? Anyone? How do you carry out a appointment of the auditor in case of the banks? How do you carry out the appointment of auditor in case of banks? See, again on 31st July, the way we had for the NBFC, Department of Vision, some regulations on the audit, we have the regulations on the banks. We will go to the statutory audit directions 2026. Okay. Now, first of all, let's understand these directions, okay, are applicable to basically and statutory auditors. Okay. And commercial banks means banking companies other than small finance bank, payment banks, and local area banks. And the State Bank of India, because State Bank of India is basically covered over there. Okay. So State Bank of India, new banks, commercial banks, and banking companies are covered other than this. Those are the commercial banks. Now, how it works basically, how the auditor is appointed. Okay. Basically, when I talk about the appointment of auditor, here the number of auditors that are required to be appointed, it is the role of board and senior management to decide the number of statutory central auditors or statutory auditors based on the details which is given. So these are the the responsibility of the board, that you decide the number of auditors. Board has to decide the number, like, okay, how many are required to be appointed. Now the question comes is, okay, we decided the number based on the criteria. Remember, we saw the criteria in the NBFC that up to 5,000, 5,000 to 10,000, 10,000, 20,000, or 5 lakh to 10 lakh, 10 lakh to 20 lakh, above 20 lakh, the maximum number of statutory auditors. Okay. The way we had in the NBFC, similar we have for the banks. Now the question comes is that who appoints them? Who appoints them? This is the requirement over here. Okay, that the number of maximum, but appointment from where it will come? Anyone? Okay. Now over here, there are two things we need to understand. First of all, whether it's a public sector bank, it's a limited company, or it's a not a public sector bank. It is other than public sector bank. Accordingly, we need to understand. So what regulation basically say, and that is very important. For a public sector bank, PSB, the office of CNAG will continue to empanel audit firms eligible for appointment as the statutory central auditor based on the norm prescribed by RBI. Okay. The list of firms as furnished by the office of CAG to the RBI will be subject to the scrutiny and everything. Okay. And RBI shall forward the single list and everything. So accordingly, this will be there. And the public statutory bank shall shortlist the audit firm of the said from the said eligible list of audit firms. Okay. based on the objective criteria, full-time partners and everything. Further, the public sector bank shall place the list of shortlisted firm before the audit committee or board for the selection. Upon selection, the PSB in consultation with the ACB, shall seek the prior approval of the RBI for the appointment of the statutory central auditor. So this is how the audit appointment will work now for the banks. Okay. So when I talk about the appointment for the bank, how it will work is list will be there. Now that list basically, will be taken out by the your CNAG. RBI will look into that list. Board will, select some people. It will be open for, public comments kind of thing. Then it will be forwarded to the, RBI for the further approval. That is how the appointment is done. Okay. Second, after appointment, there are multiple things which are required to be taken care of. When we are talking about appointment, you need to take care of asset size and maximum number. Okay. You need to think of the eligibility criteria. You need to think of the audit experience, professional staff, additional consideration which may be given. Okay. In these directions, that all these directions are required to be, fulfilled. Continued compliance with the basic eligibility criteria, independence of the auditor. All these things are required to be met. Professional standards, tenure and notation. Okay. So again, tenure and notation is over and above whatever it is there in the Companies Act, and accordingly you need to fulfill. Now again, for private sector banks, like where it is not a PSU, you need to see, what is the tenure, maximum tenure prescribed under these rules. Okay. So tenure of 3 years, then 2 terms of 3 years, which may override your, Companies Act. So it is not shall be, then the auditor will not be eligible for reappointment in the same banks for 6 years after completion of part tenure, or you can say 2 full tenures of 3 years. Basically, there is a 6 year, not the 10 year as the Companies Act. Okay. Plus maximum number of 4 small banks, payment banks, commercial banks, local area banks. One audit firm can take this much amount. A lot of criteria have been brought into appointment procedures. So these are required to be complied with. Then in how much time the LFAR is required to be submitted. A lot of things have been brought into for the, auditors, that how the appointment of the auditor and the functioning of the auditor will work now under these regulations. Okay. So when we talk about the appointment of auditor, or when we talk about initial consideration, let's say all these criteria are fulfilled, then auditor basically has to, perform all the things that we have understood in the audit. All the things means initial consideration, understanding the environment, risk assessment, execution of the audit by complying the standards that we have understood. And accordingly, the auditor is required to perform the entire audit of the banks. Okay. Now, see, this is one such part that we are talking about, which is there with respect to the appointment of the statutory auditors. But in the case of the bank audit, we are not only concerned with the bank in case of the, statutory audit. There are multiple forms of audit that we as an auditor are involved with. There is also risk-based internal audit. Okay. Where the auditors are required to perform the internal audit for a particular bank. Okay. And that is also risk-based. For that, there are detailed criteria now, directions, internal audit function, that how the internal audit shall be performed. There should be policy, functional independence, okay, risk assessment, Like this is the risk metrics actually you are required to prepare now, the control risk and the inherent business risk. Okay, which are, and you need to plot the areas, like you need to drop this risk evaluation metrics, you need to identify inherent business risk, you need to evaluate the effectiveness of the control systems and prepare this metrics. Okay, now they have given this detailed understanding how you are required to perform the risk assessment. Okay, plus you are required to consider the following parameters: previous internal audit reports and compliances, proposed change in business line, significant changes in management, result of latest regulatory examination report, reports on external audit, industry trend, time elapsed since last audit, volume of business, substantial performance variations. A lot of things you are required to consider when you are performing the risk assessment. You need to then think of the frequency of the risk and the magnitude of the risk and prepare this metrics. Okay, again there are criteria given that what you need to consider in that. You need to communicate. Again, SA 260 265 performance evaluation. Okay, a lot of things are given in that basic level, okay, which a particular auditor is required to consider when he is performing the internal audit of the bank. Any doubt till now? Any doubt? Any doubt till now? No? Okay. See, what we understood till now is that these are certain appointment related and functioning related requirements. But how to perform that particular audit? Let's say, for example, if I want to perform the audit of the commercial bank, internal audit, how I need to perform, what areas I need to see into, what are the operational aspects that I need to look into when I'm performing the internal audit of a particular bank. Over there, these directions come into the place. Okay, area-wise directions. Why? Because these directions tell that how a bank should operate. Plus, there are multiple circulars issued by RBI from time to time that a bank is required to comply with, which the bank has the access to. But those are the basic things that you need to see when you are performing the internal audit. For example, in general terms, when you are performing the internal audit, okay, when you are evaluating the internal controls, few things that you need to check with respect to the general area. Okay, we will go to the specific also. Generally, what you are required to check, okay, whether the maker checker concept is there or not, that the work of one person should be checked by another maker checker. Okay, they are shifted from one position to another frequently without prior notice to identify, if a one person is there on a particular position for a long period, there are chances of fraud. Okay, arithmetical accuracy of the books should be proved independently every day. Plus, there should be, all banks forms and all these should be in the possession of the officer, and there should be, stock of such stationery. Plus, there are multiple things that the banks are required to do. Those are required to be complied with respect to the internal controls. There should be controls on those areas. Okay. And accordingly, basically, few general areas are there that are required to be checked by the auditor when you are evaluating the internal controls. So if I talk about cash, then cash should be in joint custody of two responsible officers. In addition to normal checking by the chief cashier, there should be surprise text check or daily test check of the cash, or occasionally full count of the cash which is there. Okay, plus Payment should only be made after the vouchers. Okay, few basic things which are related to the operational aspect of the bank that you need to understand. And then only you will be able to test those controls. For example, if I ask you, what are the areas with respect to the internal controls that the auditor should check when he is required to take the comfort on the loans and advances? If a particular auditor wants to take a comfort on the area of loans and advances and internal controls on that particular area, loans and advances, what he should check? Anyone? So the controls that the auditor should look into when he's talking about loans and advances, when he's testing the loans and advances. Anyone? Very important, because from here we will now understand how operational aspects are required to be verified. Anyone? Loans and advances we are talking about. And again, that is something not we are talking about, from the perspective of that, okay, this is something, let's say, not given in the public domain. It is there. Everything is based on the regulation. So regulation specifies, the law specifies something that is required to be implemented in the processes, and those processes are required to be controlled, monitored by a control. So relevant internal controls are required to be placed, to ensure the processes are working appropriately. Loans and advances. No, let me tell you. Okay. So when I talk about loans and advances, okay, so there are few things, like basic things we need to understand. Internal controls around loans and advances. Number one, when a loan is being given, is there any check being performed on the credit worthiness? Okay, credit worthiness check is being performed or not? Like what loans are being provided, to whom the loan is being provided, whether the documentation is there or not, whether the collateral is there or not, whether the person will be able to repay that loan. So is there any control around the credit worthiness? Second, for the amount of the loan, whether appropriate approvals are being taken or not. Okay, so you need to think from the approval point of view, that whether the approvals have been taken or not, so that if there is a requirement of the approval, and if someone bypasses that requirement and issues the loan, then is there any control around the approval? If yes, whether that approval has been taken or not. Okay, then necessary documents. What documents have been required to be obtained, and whether those documents has been obtained or not. Okay, so necessary documents, proper authorities and sanction or approval from them, credit worthiness. Then whether they have the security and margin in the security. It never happens that there is a loan of 100 and the security is also of 100. No, what they will do is, instead of loan being given of 100, they will provide you the loan of, let's say, 70 or 80. They will keep a margin of 20, that okay, security should be always higher than the loan. So whether that margin is there, and margin as per the procedures. Then basically all the security should be returned and received by the responsible officers. So security should be kept in the joint custody of two officers. There should be a registration of the securities. Yes, there is a registration of securities required in the name of bank. Okay, accompanied by the document sufficient to give it the title to the bank. Even in the mortgage also, home loan or housing loan mortgage, there has to be a registration of that particular property, in mortgage of that registration of that property with the bank is required. Plus, if there are any temporary limit sanctioned, okay, whether they are renewed or whether they are reviewed within 90 days. Okay. If there is a ad hoc limit provided, then whether they are reviewed on a timely basis or not. If the account exceeds the sanction limit, whether the account is irregular, then you need to inform a relevant person for whether to make it regularized or whether to we obtain additional securities for that. So some areas with respect to the internal control on loans and advances. Okay. Now, okay, this is internal controls that we talked about. What about the audit procedures in this area? What audit procedures you will perform to take the comfort that the bank is operating appropriately, okay, with respect to this? Like the loans and advances are being managed appropriately with respect to your, the functioning of the bank and everything. So what audit procedures you will perform with respect to the advances? Audit procedures. Now we are shifting from the internal controls to the audit procedures. Anyone? Audit procedures for the advances. See, the operational side, you need to verify whether they have complied with the operational guidelines and the regulations or not. Operational guidelines. What are the operational guidelines? You provide or you update all the details of the loan correctly in the system, including loan accounts, interest rate, EMI, tenure, everything should be updated in the system correctly. Customer should be tagged with the customer ID. Each customer should be tagged with the customer ID. You need to examine the large advances on sample basis with all these parameters. Okay. NPA, whether a particular account is an NPA or not. How will you identify that? There are guidelines. See, there are guidelines given in the the directions issued by the RBI. So this is the asset classification provisioning directions issued by the RBI, and over there is a classification of NPA. Let me go to the page 10. This is the classification of NPA. So you need to examine if the interest is overdue for the period of 90 days or more in case of a term loan. It will be NPA. If a particular advance is classified as an out of order in respect of an overdraft, it will be an NPA. Now, what is the out of order? There is a definition of that. When a particular cash credit and overdraft, okay, remains continuously in excess of the sanction limit or drawing power for 90 days. There are no credits continuously for the 90 days. Credits are not enough to cover the interest debited during the previous 90 days. That will fall under the category of the out of order status. Okay. Out of order, if any of the following. So, any one is satisfied. Not necessary all. Any one is satisfied that the outstanding balance remain in excess of the sanction limit for 90 days, no credit for 90 days, or the credits are not enough to cover the interest debited during 90 days. In that case, it will be taken as an out of order. Okay. Now, again, if it is out of order, it is NPA. Directly, there is no 90-day criteria for, again, the NPA. The moment it is out of order, it becomes NPA. Drawings are permitted for a continuous period of 90 days in case of OD or CC account, okay, based on the stock statement. If the drawings are permitted for a continuous period of 90 days in case of OD or CC account, where drawing power sanction is based on the stock statement older than 3 months. That means 3 months have expired. Now for the 90 days, you are continuing that. Okay, let's say 3 months expired on 31/12/25, and from there 90 days have passed. Okay, and then it will become NPA on 91st day. Okay, so additional kind of not 3 months but 90 days. Remember, the stock statement is 3 months, but for NPA it is 90 days. So if the months is February or March and January included, December is included, you need to see when the 90 days are gets over. 2 crop season overdue. The loan is overdue for short duration crops. Okay, and 1 season for the long duration crops. Liquidity facility remains outstanding for more than 90 days. Credit card minimum amount due not fully paid within 90 days from the payment due date mentioned in the statement. Interest or installment for debt instrument unpaid for more than 90 days. So everywhere this 90-day criteria is there, similar to what we have seen in the NBFC ML. Okay, it will become NPA. So you need to see whether it is NPA or not. Then you will check, there are certain accounts, okay, where bank has exposure. Okay, so for example, one customer will have multiple accounts. For example, customer A will have term loan, will have CC, or will have credit card. Over there, you need to follow this. If bank has more than one exposure to the borrower, and if any exposure classifies as an NPA, you need to consider all exposures as an NPA. That means if term loans becomes NPA, this will make NPA this also and this also. Okay, so the entire borrower will become NPA. So classification of NPA has to be done at borrower level. You need to see that. Plus a particular, okay, not for the one facility, for whatever NPA is there, to all the credit facilities. So arrears of interest and principal pertaining to all the credit facilities. And then only you need to classify that as a standard asset. Otherwise, you cannot classify. So if there is a standard asset, you need to see whether this has been classified appropriately with respect to upgradation. So if we see that, okay, customer of bank is tagged under single customer ID to list all his accounts. Advance large advances, examine large advances. Again, NPA category, you need to see whether NPA or not. Then restructured accounts, quick mortality accounts, that they become NPA within 12 months of sanctioning it. Completeness and accuracy of interest being charged, appropriate analytical procedures you need to perform. Okay, that is one thing. Then classification is required to be done based on the NPA. So classification of and provisioning. So based on the NPA, you need to see what kind of asset it is. Okay, correctly classified and provisioning is required to be done for that particular loan account. You need to see that. Plus account regularized near balance sheet date. Remember, we just now discussed that if there is an account regularized, you need to see that it should be repayment by the borrower, which makes genuine repayment should be there. Okay, out of the genuine sources. So if I talk about the regulation on that aspect, there are detailed guidelines again given in the regulation. If a particular account is being regularized near balance sheet date. So classifications are there, other prudential norms are there that is required to be followed. Okay, and if you see the balance sheet one, So basically, you need to check on the each balance sheet date, like what is the thing, whether it's from the genuine cause or genuine funds or not. So again, that is part from the operational aspect which is coming over there. Okay. So every NPA is required to be done for the day end process. Okay. So when you classify NPA at the end of that particular day end, let's say 90 days is done and that day is going to complete, then you need to classify that as an NPA. Okay. All these things are required to be checked. Let's say SMA NPA classification again. So you need to see what is the SMA NPA classification of that particular facility. All these things you are required to follow. You need to check whether these are being followed by bank or not. Plus, there are additional, directions or requirements which are being given from RBI to banks on timely basis that are required to be followed. Okay. So a lot of things are there in that particular category that a particular bank is required to follow with respect to the NPAs. Okay, to identify whether these NPAs are happening near the balance sheet date or whether they are regularized at the balance sheet date, just to avoid the reporting in the your financial statement. Okay, so you need to see what is the main correct, what is the funds from where they are regularized. Then there could be a specific criteria, so specific scenarios which are required to be considered when we talk about NPAs. For example, drawing power calculation. We have already seen that in case of a drawing power, you need to consider the statement from the borrowers. You need to obtain the statement that should not be older than 3 months. Okay, and if it is older than 3 months, you need to see whether 90 days has passed or not. If passed, then it will become basically NPA. Okay, but only there are something called a temporary deficiencies. What is a temporary deficiency? That means that there is some deficiency which is temporary in the nature. That is a non-availability of the drawing power based on the latest stock exchange statement. Okay, so let's say for example, 3 months are over. Up to 90 days, we can call this as a temporary deficiency. But after 90 days, okay, after 90 days, I cannot call this as a temporary deficiency. I have to say that it is irregular. Okay, if the outstanding in the account is based on the drawing power calculated from the statement older than 3 months, it is required to be considered as the irregular, and again, it will classify as a NPA. So up to 90 days, I can say that, okay, this is something, temporary deficiency as of now, which is not required to be classified as an NPA. Later on, if it exceeds the 90-day criteria, it will become the NPA. If the limits are not reviewed, okay, ad hoc limits are not reviewed within the 180 days, then you need to see whether any limit review is happening or not. If not, then it will be classified as an NPA. Again, a set of classification borrower wise, not facility wise. Remember, 3 particular assets are there: term loan, CC, and credit card. If one goes irregular, the entire set of the exposure to that particular borrower is classified as an irregular. Okay, so borrower will have to be treated as an NPA and not the particular facility. Okay, government guarantee advances. Let's understand the government guarantee part from the regulation itself in a very good way. Okay. Now, what government advances or government guaranteed advances are required to be looked into? Basically, a particular investment in the government security, okay, or a SLR eligible state government, eligible securities shall not be classified as an NPI. What is NPI? NPI is kind of similar. When we talk about non-performing asset, if there is an investment instead of asset, there is an investment. And if 90-day criteria are being followed, that the interest is not paid on the investment, or you have not received the interest, or you have not received the relevant, income on that particular investment, that investment will become NPI instead of NPA. Okay. If there is a financial asset backed by a guarantee of central government, okay, though overdue, shall be treated NPA only when the guarantee is repudiated when invoked. So there are three things to consider. First, there is an invocation of the guarantee. There is a repudiation of the guarantee. Okay. And that guarantee is by the central government. If these three things are there, then only treat that as an NPA. Otherwise, do not treat that as an NPA. But this is not applicable for the purpose of income recognition. That means when you are required to recognize the income, okay, remember there was something we learned in the NBFC that for NPA, the income is only recognized when realized. Now, when I say this asset is not required to be recognized as an NPA, so financial asset backed by CG, central government guarantee, okay, then in that case, I will not count as an NPA. That means I can recognize the income. If I say it's not an NPA, I can recognize the income. I classify this as a standard asset. But provision says otherwise. Provision says that if you are exempting a particular NPA on basis of central government guarantee, okay, then for the purpose of income recognition, count that as an NPA. For the purpose of asset classification, don't count as an NPA. So in case of government guarantee, backed assets, financial assets, okay, for the purpose of asset classification and for the purpose of income recognition. Asset classification, standard asset, provided three conditions, okay, provided three conditions. And for the income recognition, irrespective of, it's an NPA. Okay, remember this. This is the overdue. Okay, overdue portion, not the portion which is normal. So if a financial asset which is overdue, financial asset backed by guarantee, overdue, which is not either invoked and not repudiated, in those cases not to be counted as an NPA. Only count NPA when invoked, repudiated, backed by central government. Again, state government not part of this. State GOT not part of this. Simple. Okay. There are other conditions also, we will not go into that. But this is how you need to classify these central government guarantee based advances. Same. So NPA only when repudiates its guarantee when invoked, otherwise not. Okay. Now that is only for the asset classification, not for the income recognition. Agriculture advances, we saw that it will NPA for 2 crop durations, short term, 1 crop duration, long term. Accordingly, you need to follow that. Provisioning requirement towards the standard asset. There is a provisioning requirement we have already seen in the NBFC, similar applicable over here. Okay. Then upgradation of the account. You are required to upgrade account only when entire amount has been paid. Only when the entire amount has been paid from the genuine sources. Otherwise, do not upgrade the account. Plus, there is something called sale and purchase of the NPAs. Banks can sell and purchase the NPAs. Yes. there's a policy which the banks are required to follow. Okay, that when they can sell and purchase the NPA. Okay, uh, there are procedures that are required to be followed. Like they should be sold without recourse only. Okay, plus subsequent to the sale, the bank does not assume any legal, operational, or any type of risk on that NPA. NPA should be sold on cash basis only. Okay, the bank should not purchase an NPA from any other bank. Okay, in case of the NPA sale, the auditor is required to see that it has been removed from the books. Plus, it has to be removed from the provision. If the NPA is not there, you are no required to, make the provision for that. The sale should be at the price below the net book value. It will be a problem. Okay. If the sale value is higher than the net book value, then the excess should not be reversed, but should be utilized to meet the shortfall on account of sale of other NPAs. So, if let's say, for example, financial asset was 100, let's say the provision was booked 40, so the net book value is 60. Let's say sold at 70, so you have a profit of 10. This profit is to be used for other NPA sale loss. Do not take to the profit and loss account, but use for the loss or shortfall or account of sale of other NPAs. If this is 50, instead of that, let's say if this is 50, then there will be a loss of 10. So, if there are such losses, this profit is required to be set off in such kind of losses. Okay. Plus, let's say, for example, if the bank has purchased the NPA subject to the provisioning requirements and all other things, then it is as per the regulation or not. So all these things are required to be verified for the advances. A lot of things we have discussed that the auditor is required to see from the substantive side. Clear? Any doubt? Any doubt? If no doubt, then let's do one thing. Let's take a quick 10-minute break. After the break, we'll gather back and continue the session. Okay, let's take a quick 10-minute break. Break start. Okay. Hello everyone, welcome back. Let's continue the session. And to understand further the audit of a bank, let's dwell into some questions. That is very important. Okay. And these questions will help us to understand how basically, you have to write the answer in exam. Okay. So the question is, during the statutory audit of a fair bank, you are examining the cash credit account of Messrs. Bright Traders as of 31st March 2025. Now, what are the things which are there? The following facts are observed. Sanction amount 4 crore rupees. Outstanding as on 31st March 4.10. Excess over limit 10 lakh for 15 days. Renewal of limit was due on 28th February 2025. Interest is regularly serviced and no amount is overdue beyond 90 days. Drawing power is properly calculated based on the stock statement less than 3 months old. The manager has treated this account as a standard asset. Examine whether the account requires a classification of the NPA. Okay. You have this detail, like there are some limits, some details given. On the basis of that, you need to answer whether this account is required to be classified as an NPA or a standard. Based on whatever we have discussed, what do you think? Should we classify this account as a standard or should we classify this account as a NPA? Quickly. NPA or standard? Interest is regularly served. Drawing power is properly calculated. Renewal limit was due on 20th Feb 2025, which is under progress. Latest stock expense 31st January 2025. As of 31st March, outstanding balance 4.10 crores. Excess 10 lakh rupees for 15 days. What do you think? Regular NPA. What I will, okay, let's say for example, if you say standard or if you say NPA, how will you quote that in the answer? What you will quote? Okay, like whether NPA or standard, how will you quote that in answer? Anyone? Because see, you might know the answer of NPA, non-NPA, standard, whatever it is, but you need to write the detailed answer for that also. That is very important, and that is what you need to understand, how to write the answer. How will you write the answer? Quickly. I cannot write in exam that, okay, I feel it should be standard and hence standard is the correct answer. I cannot write this one-liner answer. Yes or no? I need to write something. I need to write and explain on what basis I am actually calling this as an NPA or a standard one. So basically, if I have to write the answer, what I will write? Yes, very good, Kanaya. What I will write? I will specify the provision first. That if there is some temporary deficiency, okay, for that, I should not treat the account as an NPA just because there's a temporary deficiency, which is temporary in nature. Okay. If the outstanding amount or if the, outstanding amount is more than the sanction limit, okay, for more than 90 days, okay, plus the drawing power is calculated based on the stock statement which is 3 months older and that has to more than 90 days have happened for that, then only I will count that as an NPA. Yes or no? Now in this current case you need to explain the current scenario, that what is happening, and on the basis of that, this as a temporary deficiency, I will not classify this as an NPA. I will classify this as a standard asset only. Simple. Clear? Straightforward. When you are writing the answer, you have to be, write in an appropriate way. For example, here is the answer that in the given case, the borrower, you need to specify the detail. This is the provision that bank should not classify. Provision. Okay. Now here is the conclusion. Okay. Now this is the case which is given. So what I did is I specified the case, I provided the provision, and then at the end I said no, it should be standard asset by the branch in accordance with the IRAC norms. Simple. Straightforward. Clear? Now let's see one more question on the similar line. Very good question. Question is, you are auditing the branch operations of Axis Bank, a scheduled commercial bank, for the year ended 31st March 25. During the audit of the loans and advances portfolio, you observed the following. Advances were sanctioned without proper credit appraisal in some cases. Certain loans were sanctioned without adequate documentation, like demand promissory notes and hypothecation letters. Okay. In several branches, securities were held by a single officer. A few loan accounts have been exceeded the sanction limit. On pointing out the above, branch manager replied that they rely on the internal control framework to mitigate such risk. Based on the above situation, explain the internal controls that the bank is expected to implement in the areas of loans and advances. Trust me, the answer lies in the question itself. The answer is in the question itself. Okay, so tell me, the internal controls that the bank is expected to implement in the areas of loans and advances. You need to explain those internal controls. Come on. Explain the internal controls that the bank is expected to have in that area of the loans and advances. And your answer is in the question itself. Half of the answer is in question itself. Quickly. Anyone? So basically, what you are required to do is, first of all, when I say advances were sanctioned without proper credit appraisals in some cases, we saw a control where we talked about that there should be appropriate credit appraisal, then only advances should be there. So proper authorization should be there, proper credit appraisal should be there, and there should be control around it. Then we saw that there should be approval mechanism for each and every loan. So loan should be approved, then only it should be dispersed, and there should be controls around the documentation also. Then there should be controls that the security should be held in the joint custody. Then there should be a control that the accounts which are exceeding the drawing power should be intimated to the head office on a frequent basis. Yes or no? The problems which are there in the question, there were controls around that, and accordingly those controls are required to be implemented by the bank. Those are the controls which are expected by the bank. And if we see the answer, those are the answers only. For example, the bank should make advances only after satisfying itself to the credit worthiness. Necessary documents should be executed. Sufficient margin should be kept. All securities should be returned in the joint custody. Okay. Securities requiring registration should be registered in the name of bank. Account should be kept within the drawing power. And if there is an exceeding, then you need to brought to the attention of the head office. Operation should be reviewed at least once every year in advance. So these are few controls that the bank should have in the areas of loans and advances. Simple. Any doubt on this? Any doubt? So that was loans and advances, very important area. Now the next part is that we need to understand on, okay, if no doubts, we will proceed and understand a very important area of the bank. Because see, what happens is we are understanding area by area. Okay, area by area. Now we are going to understand something called your CRR and SLR requirements. Your CRR and SLR requirements. Can anyone tell me from where they come into the picture? What and where this requirement is enumerated? Okay, why banks are required to follow these requirements? CRR or SLR? Anyone? Subprime crisis. Very good. But as of today, where it is written that banks are required to follow these things? Any specific rule, provision, or law do you think it is there where this requirement is mentioned? Anything that you can think of? Where do you think this requirement is there? Anyone? Any such requirement in the act, rule, regulation that you think that makes the banks or requires the banks to maintain this? Let's understand that, because from where it is coming, we need to understand, to have a background of it, what is required under this, and from where the things are running. Okay, basically now we will go a very important part of the banking regulation. Banking Regulation Act provides this kind of requirement, and we will see some sections on this. So Banking Regulation Act basically talks about cash reserve. Banking Regulation Act talks about a cash reserve, that every banking company, not being a scheduled bank, shall maintain by way of cash reserve with itself, or by way of a balance in current account with the RBI, okay, or by way of a net balance in the current accounts of one or more categories, a sum equivalent to such percentage of its total demand and time liabilities in India as on the last Friday of the second preceding fortnight, as the Reserve Bank may from time to time notify. Means RBI will notify that how much cash reserve a particular bank is required to maintain from time to time, which is part of its demand and time liabilities. Okay. And over there, that is required to be calculated every fortnight. Can anyone tell me what is the current cash reserve ratio that the banks are required to maintain? Very good. Yes, the current cash reserve ratio as per the RBI is 3%, which is you need to maintain as per the demand and time liabilities in the India, total of its demand and time liabilities. Okay. Okay, and that is required to be calculated on the last Friday of the second preceding fortnight. And you need to submit the Reserve Bank of India before 20th of every month a return, okay, showing the amount held on the alternate Fridays during the month with the particulars of its demand and time liabilities in India. Okay. And what percentage was maintained as a cash reserve ratio. That means you need to show cash reserve ratio plus you need to file a return. We will see return later on, but these are things that as a bank you are required to do. Now, what is included in the liabilities in India? Because what it says, demand and time liabilities in India. So what is liabilities in India? Okay, that is, you need to understand current account and everything. There are other regulations that we need to see from time to time. Plus there are detailed directions issued by the Reserve Bank on CRR and SLR. Okay, there are detailed guidelines issued by the bank on the cash reserve ratio and the statutory liquid ratio that is required to be followed. Very important area of a bank. Now, why we are saying very important area of a bank? The reason, because when we are auditing this area, whether the bank has fulfilled or not, over there is a responsibility of the auditor also. Okay, I'll just show you first the reporting part. Why I'm saying there is a responsibility of the auditor. So there is something called reporting requirements. Okay, RBI is required to submit a return in Form A at the close of bank is required to submit a return in Form A at the close of business on the last day of each fortnight within 5 days. Okay. Now this Form A is required to provide a lot of details, which has multiple sections. Okay, a lot of things are required to be provided in this Form A, which is a fortnightly return, and this is submitted to the RBI. Fine. And there is a another Form 8 SLR return which is required to be submitted. Now there is a requirement that the statutory auditor shall verify, certify all the items under the net demand and time liabilities in the fortnightly, monthly statutory returns submitted to the Reserve Bank, or for all the items of outside liabilities. In order to do that, you need to understand what is included in these returns. Then only you will be able to certify that. Okay. If you do not understand what is included in the outside liabilities, you will never be able to certify that. Okay. Now, that's where these regulations become very important. What is included in the demand liabilities? What is included in the time liabilities? What is not included in the time liabilities? Okay. What is required to be excluded, inclusion, exclusion, all these things are required to be understood. Otherwise, basically, you may calculate incorrectly or the bank may calculate incorrectly, and as a result, what will happen is that you will not be able to certify appropriately. Plus, there are various reporting requirements on the auditor with respect to the reporting of multiple things. When I talk about auditors reporting, there are multiple reporting requirements on the auditor. That how an auditor is required to report things for a bank. I'll just show you some things, some areas on that. Okay, so that you can have an idea how the reporting happens with respect to the bank. So remember, we saw a regulation, something called basically, statutory auditor regulations. Similarly, there are other regulations. Apart from statutory auditor regulations, there are other regulations also. So let us see. We go to the notification, master direction. Then we go to the Department of Supervision, commercial banks. And over there, you have this supervisory returns. Okay. Now, this supervisory returns basically provides what returns are to be submitted and how they are required to be submitted. For example, return on asset and liabilities, return on asset quality, all these returns, liquidity return, fortnightly, part A. Okay. Return on capital adequacy, return on interest sensitivity. A lot of things are there in this. A lot of returns are specified in this. The banks are required to submit from time to time. Okay. Plus, they have a return on allocation of branches to the statutory branch auditors. Then return on digital bank units. A lot of things are there. Fraud monitoring. Okay, and there are timelines also which are provided. Now, basically, when these returns are submitted, there is a responsibility on the auditor. If I go to the audit, statutory audit part, and if I go to the annexure, that's the long form audit report. Okay. Over there, like there is an indicative coverage which is required to be covered under the long form audit report. But I'll show you something. Over here, the some areas that are required to be covered by auditor is the management information system, that the existence and adequacy of the MIS or supervisory returns. Auditor is required to report on that, whether they have been filed appropriately or not. Plus, there are other things. For example, there is I'll show you annexure A or annexure 3. This is the long form audit report which is required to be submitted by the statutory branch auditor. Again, an indicative format which is given by the Reserve Bank. Now, if I talk about this particular, report, long form audit report, okay, coverage, just see the coverage that I'm talking about. Money at call, investments, okay, advances. Again, you are required to report large advances in respect of those amount is outstanding in excess of 10% of the aggregate balance. You need to provide this kind of a list of accounts examined by the auditor. Credit appraisal, like if there is any credit appraisal done by the bank, then okay, is there any non-performing asset within 12 months, quick mortality, okay, cases. Then disbursement. Let's go to the CLR and SLR as of now. We'll come to the rest of the areas in a while. Yeah. See, liabilities. Okay. We are now talking about liabilities. So if you see, KYC, management information, whether the branch has proper system of procedure for data integrity or data input, which is used for MIS, supervisory reporting purpose, which we just now saw, okay, which includes a lot of returns, okay. So basically, if you see, a lot of things are required to be reported by RBI in this indicative report, indicative long form report. Plus, in the form of demand and time liabilities. If I talk about the liabilities part over here, see, does the bank have system to identify inoperative accounts? Okay, whether the bank after the balance sheet date till the date of audit, whether there have been any unusual large movements, okay, so that the deposits and liabilities are appropriately reported. Other liabilities, contingent liabilities, a lot of things are there in this particular audit report. So auditor will only be able to report when auditor is aware that okay, how and what he is required to check. See, there is another annexure on the special areas. This is additional questionnaire applicable to specialized branch who are dealing into the foreign currency. Okay, FCNR, NRE, NRO reporting. Okay, for example, then you have a Nostro account reporting that is required to be done. These are the reportings which are required to be done by the auditor, branch auditor. So branch auditor can only do when he is aware about what is required to be reported. Liquidity assessment. Okay, so liquidity assessment is again something with respect to the liquidity coverage ratio and net stability funding ratio. They again include how much reserves you have. Okay, so a lot of things auditor is required to report at a lot of places. I'm just showing you, overall level. For example, statutory liquid ratio and cash reserve ratio requirement. So if any discrepancy in the process of compilation, calculation of net demand and time liabilities by the bank should be highlighted in the LFAR. Now you can only do that when you know how to calculate these things. And these are calculated based on the regulations. So there are detailed regulations. Now if I show you, These are the regulations that I'm talking about: cash reserve ratio and statutory liquid ratio directions. Now, they provide a basis of computation. For example, what is included in the time liability? Fixed deposit, cash certificate, cumulative recurring deposit, time liability portions of saving deposits, staff securities, margin held against letter of credit, deposit held as a security, gold deposits. Okay. But what is not required to be included, they will provide. Like they have provided how to compute it. So liabilities not to be included in the calculation. For example, paid up capitals. Okay, instrument who are qualifying for the tier 1. Then net tax provision. Amount received from the Deposit Insurance Credit Guarantee Corporation towards the claim. Amount received from the Export Credit Guarantee Corporation. Amount received from insurance company as an ad hoc settlement. Amount received from court receiver. Now, if I talk about all these things, these are not liabilities. This is equity. That is logic we are talking about. This is equity. Is it a liability? No, this is the provision. Is this a liability? Deposit amount received from deposit insurance, bank, pending adjustment. The adjustment is pending. It is not something that I have to give it back. So this is not liability. This requires adjustment. Again, amount received from the invoking guarantee. Now, if you invoke a guarantee, that means there is a non-performing asset in front of that. So again, this will require adjustment. Amount received from insurance company, ad hoc settlement of claim, pending judgment. Again, adjustment is pending. Amount received from court receiver. Again, it is front of any liability or non-performing asset. Adjustment will be done. Liability arising on account of utilization of limits under banker acceptance facility. Now, this is the facilities are provided to the banks. Banks special fund. You can say banks special fund. Okay. Subsidy released by NABARD. Again, bank special fund. Subsidy released by state or central government. Special fund. Net unrealized gain or loss. This is again kind of a provision, which is unrealized, not a liability. Income flows received in advance, such as annual fees and other charges, which are not refundable. Again, not a liability. Like you will book on a liability side, but you don't have to pay out. Okay, it's kind of a advance income. Advance income to be amortized. So in nutshell, these entire items are those where cash outflow will not happen. So in exam, if a question comes whether to include or not, just think of a point whether there will be a cash outflow in this scenario or not. If not, these are not liabilities to be included for the net demand and time liabilities. Bill this rediscounted by a bank with eligible financial institutions as approved by the RBI. Amount received by the eligible bank from the National Credit Guarantee Trustee Company by invoking guarantees toward the claim and pending adjustment. Again, this is adjustment. So we are talking about something which is adjustment. These are not required to be included. And if a question is there, you can understand whether the cash outflow will happen or not. If not, ignore it. Those are not required to be included. Okay. So this is something. Amount to be excluded from the liabilities. Okay. This is a list just now we went through. And you now know that from where this list is coming. Okay. This list is coming from the directions. CRR and SLR directions. It is coming from there. It's not something just written from, by own. Like there is a source behind it. You need to understand that as an auditor so that, we can cover three things now. But when you go for a real audit, you have to see 10 things at that point in time. And those 10 things will be basically, kind of that you should be able to identify from where these 10 things are coming. I hope I'm clear with this point. Yes or no? And there are a lot of things with respect to this. Like a lot of adjustments are required to be made when you calculate the CRR. For example, loan out of FCNRB deposits and interbank foreign currency deposits. So if there is a loan, what you need to do? What rates you are required to take to convert that into the liability? Similarly, we have a statutory liquid ratio. Again, SLR. From where the requirement of SLR coming? Anyone? Which section requires the bank to maintain the SLR? Anyone? Which section or which law requires a bank to maintain the SLR? Which is that section or law which requires a bank to maintain the SLR? Anyone? No? CRR, that the cash reserve ratio, is under section 18. But when I talk about SLR, that is under section 24 of the Banking Regulation Act. Maintain a percentage of asset. So a scheduled bank, in addition to the average daily balance, okay, which is required to maintain under section 42 of the RBI Act, you will see what is that. Okay, in addition to the cash reserve, which is required to be maintained under section 18, shall maintain, okay, value not less than percentage as may be prescribed of its total demand and time liabilities on last Friday of the second preceding fortnight. Okay, in such form and manner as may be provided by the bank, Reserve Bank of India. That means Reserve Bank of India will provide how to maintain, how much to maintain, and how to maintain, what you need to do when you maintain this reserve. And there are other conditions, we will not go as of now in this, penalties and all those things. Okay, but as of now, remember, so there is section 24 which requires maintenance of some additional, okay, additional reserve, which is prescribed by Reserve Bank from time to time. Now let's go back to our regulations or directions. When you see the directions, okay, there is something called approved securities or SLR securities. In CRR, the Act itself provides section 18 that what are the approved securities. In SLR, securities like how to maintain will be told by the RBI. So RBI says that okay, these are the securities, that is dated securities of Government of India issued from time to time, treasury bills, state development loans, or any other instrument as may be notified by the RBI, okay, will be considered as the approved securities for SLR. Okay, these are known as the SLR securities. Now, when I talk about SLR securities, and SLR basically statutory reserve ratio, liquid ratio, sorry, statutory liquid ratio. Now, if you see, I'll show you something interesting over here. The way we have seen calculation of CRR, there is a calculation of SLR. That's the addition to the cash reserve, which is required to be maintained under this direction. Okay, value of which shall not be less than such percentage not exceeding 40 of its total demand and time liabilities as may be notified from time to time. Currently, okay, the thing which is required to be maintained is at the 18%. of its total net demand and time liabilities. That's the SLR percentage. 3% CRR, 18% SLR. Okay. Plus, there are other things also, which is known as a marginal standing facility. Okay. Where eligible banks have option to borrow 2%. A lot of things are there in that. Okay. And if someone is holding excess SLR, then there's a lending. A lot of things are there. But there are detailed requirements in this directions which talks about how to calculate SLR. So, for example, SLR assets, the bank which is required to maintain, in which the form in which bank is required to maintain cash, gold, unencumbered investments like SLR securities, dated securities, treasury bills, state government securities, any other thing prescribed. Okay. So bank is required to maintain 18% in these forms. And again, how to calculate net demand and time liabilities, we have seen already. Okay. We have seen, but there will be some addition here and there. Okay. Computation for net demand for SLR will be some addition, some deletions. Okay. So additionally, liabilities mentioned in paragraph 24, 5, 6, 7, 8, 9 are exempt from SLR. What we have seen in the CRR also. Okay. So a few additions and deletions will be there, but majoritarily things are the same for SLR also. And then the reporting comes, which is required to be done, which is required to be verified by the statutory auditor also. And if you don't do, there are penalties. Now this is Form A, just for your purpose, Annexure 1, which talks about how to report CRR or net demand and time liabilities, which is reported by the bank. Okay. Every second fortnight, second Friday. So liability to the banking system, liabilities to the others in India, asset with the banking system, cash in India, investment in India, bank credit in India. Okay. Total of everything, net liabilities for the purpose of Section 42 of the Reserve Bank. Okay. Then saving banks account, demand liabilities, time liabilities in India, and accordingly you need to provide the details. Again, Section 72 of the Reserve Bank of India provides that how to do some additions and deletions. So there are multiple things which are there, which are required to be calculated. Okay. See, amount of deposit required to be maintained as per the CRR. Any other liability which CRR is required to be maintained as per the current instructions. Total CRR required and maintained under Section 42(1)(a) of the Reserve Bank of India. Why we are talking about RBI Act over here? Can anyone tell me? Why we are talking about RBI Act? We were talking about basically, if you see Banking Regulation Act. Now, why suddenly RBI Act is coming into the picture? And Section 42. Anyone? Very interesting, huh? Because this is something, if you have paid attention, you will come to know why Section 42 RBI Act is coming into the picture. I'll show you quickly. What was the section for CRR? Section 18? Yes or no? And Section 24 for the SLR? Now what it says? Let's go to for the CRR first of all. Section 18. Section 18 CRR. It says that every banking company, this is very important part that is we need to look into. Every banking company not being a scheduled bank. If scheduled banks are not covered under Section 18 of Banking Regulation Act, then where they are covered? They are covered under the RBI Act, Section 42. Same requirement, but for the scheduled banks. Basically, for scheduled banks, there is a Section 42 of the RBI Act. I'll show you. Okay. Section 42 of the RBI Act basically prescribes the same requirement for the scheduled banks, which are excluded from your Banking Regulation Act. See, cash reserve of the scheduled banks to be kept with the bank, which is not there in section 18. It is covered in the section 42. Every bank in the second schedule, that's a scheduled bank, same requirement. That's where when we are seeing the regulations, we are seeing section 42 and 42 1A, because that is applicable to the scheduled banks, which are there in the second schedule of the RBI Act. Now this is annexure A, again same, foreign currency liabilities. Okay. And then form annexure B, investment in approved securities for the purpose of SLR. All these things are required to be submitted. And form 8 of the banking regulation. Now, who auditors or the banks which are required to comply with the banking regulation, commercial bank, not the scheduled bank, how they are required to report. And everywhere, if you see, this is required to be verified by the auditor. Clear? So when I talk about auditing of SLR and CRR, you need to understand that this is based on the Friday balance, which is consolidated at the head office. You need to calculate the DTL position, okay, on every reporting Friday. That is the every fortnight, okay. Now auditor needs to verify the correctness. You know now from where the correctness verification requirement is coming into the picture. Why auditor is required? The addition, deletion, plus interest accrued on the deposits. Okay, these are the things which are required to be included or understood. For example, while examining the computation of DTL, auditor is required to examine the minimum eligible credit, long-term infrastructure bonds as per the RBI circulars, eligible increment FCNR deposits. Okay, reporting in form A. You know now where is the form A. Maintenance of CLR, SLR on foreign currencies. You know from where this is coming now. We have seen this. Okay, so form A we saw, form 8 we saw. Okay, now these references are not only references but live examples that you have seen. See this form 8 of the Banking Regulation Act. This was the form 1, form 2 that we were talking about. Sorry, form A that we were talking about, and various annexures to the form A. So it's not something theoretical we are talking about. We have seen these requirements. Okay, how this is required to be verified. So this is how the SLR and CRR things work on ground. Section 24 of the Banking Regulation Act for the liquid assets, and section 18 of the Banking Regulation Act for CRR. And similarly, you have section 42 of RBI Act for scheduled banks. Clear? This is how actually this is done on ground. Any doubts on the CLR and SLR requirements? Any doubt? See, this is very important to understand from where the regulations are coming. And secondly, your own reading of the chapter. So your own reading cannot substitute anything. You need to read the chapter. That is very important. Very, very important. Your own reading is carries a lot of importance in this chapter, because you need to read, you need to understand from which regulation, which area is there. Then only you will be able to understand how the audit is actually performed. Okay. If you will not perform the reading, you will not be able to understand the chapter. This chapter requires, chapter number 14, unit 1 and unit 2 requires your reading. A reading that basically, will help you to understand this chapter entirely. Otherwise, It will be something kind of scenario that you will not be able to understand from where the things are working, how the things are moving in this chapter. Any doubt till now? Any doubt? Yes, no? Whatever we have discussed on the CRR, SLR, advances, any doubt? No? Okay. If no doubt, let's proceed ahead and discuss one more important topic on the similar lines, which is your investment. Remember, we discussed something called, we said that, okay, the way the assets are there in a particular bank, okay, what are assets? Your deposits are the assets. Your loans which are given are the assets. In a similar way, banks are required to make investment. We have seen now for the SLR securities also there. There are other type of investment which banks makes, and banks are allowed to make some investments. Now, there could be a scenario that that particular investment becomes non-performing. Yes, I'm correct. Investment can also become non-performing. If an investment becomes non-performing, then what to do? And how to identify investment is a non-performing investment? Okay, that's where we need to understand one more set of regulation, which basically talks about understanding the investment portfolio. Okay, now this is classification. The regulation that I'm talking about, classification, valuation, operation of the investment portfolio. Okay, this basically talks about classification of the investments and how the investments are required to be recorded. Basically, first of all, you need to understand what is general guidelines with the investment for a particular bank. Okay, bank is required to adopt a comprehensive investment policy that is necessary, which shall include a lot of details. For example, the investment criteria and objectives, securities in which investment can be made by the bank, because bank is dealing in money. So you need to make sure that, as a bank, bank needs to make sure that they put the money at the correct place. And as an auditor, we are required to verify this policy. Derivatives in which bank shall deal, the authorities to put through these deals, adherence to various prudential exposure limits. A lot of things are required to be done in that policy. Okay. Plus, there is a categorization that is required to be followed for these investments. Now, banks are required to categorize. Banks are required to categorize investments basically into, let's say, for example, this is held to maturity, available for sale, fair value through profit and loss account. Okay. Except for the investments in own subsidiary, joint venture, and associate, bank is required to categorize in this particular way. Okay. Now, when I talk about bank is required to categorize, that means bank basically has to classify all these investments in these categories. Plus, the held for trading HFT is required to be further separately classified as an investment subcategory within the fair value through profit and loss account. So held for maturity, available for sale, and held for trading shall be separate investment subcategory within the fair value through profit and loss account. Okay. Plus, the bank is now basically required to report these in Schedule 8 of the investment. You already dealt with this, like how this investment is required to be reported in Schedule 8, government securities, other approved securities, share debenture bonds, and subsidiaries. Apart from that, this classification is necessary. You have already seen that. And how this classification is required to be followed? if a particular security is like, supposed to be held to maturity, that means if the bank plans to hold that security till maturity, it will be classified as a held to maturity. Okay. Which securities are held to maturity? Securities acquired with the intention or objective to hold till maturity. The contractual terms of the security give rise to the cash flow that solely payments of the principal and interest and outstanding, SPPI criteria is there. So if that is the case, then held to maturity. Okay. Then there is a another category which is known as basically securities kind of available for sale, AFS. That the bank classifies that these are available for sale. Bank wants to sell these securities. Okay. So if there is a particular security which bank thinks no, we want to sell it, that will be classified as a available for sale. Okay. That is security acquired with an objective that has been achieved by collecting the contractual cash flow. Now bank want to sell it. That's available for sale. Then investment or securities fair value through profit and loss account. These are equity shares other than equity share in subsidiary, associate, joint ventures. Okay. These are the investment in mutual fund, AIS, real REITs or infrastructure investment trust. Other securities are there. And there are securities held for trading. Okay. Bank is required to include those financial instruments into held for trading. Sorry. Where there is no legal, restriction against selling or fully pledging it. So if there is no restriction on selling or pledging it, bank can classify as a held for trading. And bank shall, fair value these held for trading instrument and recognize any valuation change in the profit and loss account immediately. As the name suggests, they are held for trading. And when you say fair value through profit and loss account, again, these are also required to be kept in that way only. Okay. So there is a classification given that how investments are required to be classified. Okay. Plus this criteria is given. Solely payment of principal and interest criteria is required to be understood. Okay. How this criteria is applicable. So a lot of details are given on the basically investment plus initial recognition that how investment is initially is required to be classified. Okay. So bank shall measure all investment as fair value on initial recognition. This is over and over your accounting standard that how recognition should happen. And then subsequent is also there, subsequent measurement. For example, bank shall carry security as held to maturity as cost and shall not be marked to market after initial recognition. Only HTM category. But when I talk about other categories, for example, fair value through profit and loss account. Okay. So at that point in time, bank is required to, fair value these securities and net gain and loss shall be classified directly to the debit and credit to the profit and loss account. Again, for example, when I talk about held investment available for sale, these require valuation on at least quarterly basis. So fair value on quarterly basis, if not more frequently. And then if there is any discount or premium on the, on these securities, basically on the acquisition kind of, you need to amortize that particular amount. Okay. And there is, way how to amortize that. The amortized amount shall reflect in the financial statement under item 2, income from investment of schedule 13. Okay. And interest earned with a contra in invest schedule 8 in the investment. So how you need to amortize, the details are given that way. Okay. Then upon sale, what you need to do, that is also given. So a lot of accounting expect, recognition expect, subsequent measurement expect is given for these. Plus there is a expect given reclassification between these categories. So if you want to classify from held to maturity to available for sale or fair value, then what you need to do? If you want to classify from available for sale to held to maturity or fair value, what you need to do? And vice versa. Sale of investment, at the time of sale of investment for held to maturity, what you need to do? Fair value of investment. quoted, unquoted, SLR, unquoted SLR, non-SLR. A detailed requirements are given for this entire section of securities that the banks are required to follow. Okay, security wise, internal control system on these, like how internal control should be there. For example, there should be clear functional separation on trading, settlement, monitoring, controlling, and accounting. Okay, these functional separations of trading and back office functions, okay, relating the bank's own investment account versus portfolio management service. Let's say bank is managing some client's portfolio versus its own portfolio. There should be distinguished. There should be separation between both. Deal slips shall be prepared for every transaction. Okay, they should be serially numbered. They should be having category. A lot of details are required on deal slip. Bank shall put in place suitable internal controls on periodic reconciliation of investment book on at least quarterly basis. A bank shall adhere to FIMM-BA code. Again, there is a code that is required to be followed for execution of trade. Okay. A transaction in government securities, money market instruments, derivatives shall be undertaken as per the instructions of RBI. The control should also be there. Now, there should be a reconciliation periodically checked by the internal audit department between the books of the public debt office and the books of the bank. So there should not be any, fraud happening. Okay. So there were fraud in past where there were, like different balances with the bank's book plus the books of the public debt office. Bank shall clearly demonstrate the transaction entered by them on behalf of the PMS client. Bank shall ensure that the stockbroker serving as a director of the bank's board is not involved in any other manner. Okay, involve engagement of the brokers by the bank, audit and review and reporting. So there, how audit is required to be conducted. So there should be internal control and audit procedures for the investment portfolio. Half yearly review should happen of the investment portfolio. Okay, plus the review at minimum should cover the operational aspect of the investment portfolio. Okay, and if any major irregularities are observed in the audit report. Treasury function shall be subject to concurrent audit. Okay, and then business done through brokers should be audited by same concurrent audits. A lot of auditing requirement is there. And then comes the income recognition on that particular investment. Then NPI classification on that particular investment. How NPI is required to be classified. The way we have a NPA for investments, we have a NPI, non-performing investments. Okay. Then you have derivatives. A lot of things are there. Investment fluctuation reserve, the bank is required to be maintained. A lot of things, a lot of requirements are required to be maintained or followed by the bank, and an auditor, we are required to verify these things. Clear? Any doubt till now on investment part? So these are the directions which are applicable, on the basis of which bank is required to follow and auditor is required to verify. Any doubt? So if I quickly show you, see, investments. Now again, what we talked about, internal policy related, separate investment functions, segregation of functions, examination of reconciliation, examination of documents, physical verification. Okay, then examination of classification and shifting from one category to another, examination of valuation, how investments are required to be valued. Okay, dealing on behalf of others, PMS service. Okay, special purpose certificates. So all these things are there. Advance, we have already covered advance. Okay, so this is something auditor is required to do, and it is not coming from thin air. It is there in the regulation that we are following. So when you will read, you will be able to correlate with the regulation, that how this everything is connected to the regulation. Any doubt till now? Any doubt? Plus, we have seen auditor's report. Okay. When we talk about auditor's report, what we have seen? We have seen about the various, reporting requirements that is required to be done. First of all, if a particular bank is a company, section 143 will be applicable to them. Plus, Banking Regulation Act will also be applicable to them. Okay. Banking Regulation Act, how the financial statements are required to be prepared. Rule 11, long form audit report. Just now we saw that will be applicable. Other reporting requirements, reporting returns which are there for the bank. Okay. Plus reports and certificates that we have seen. Report on SLR requirements, long form audit report, reports on adequacy and operative effectiveness of the internal financial control. A lot of reports we have seen. Similarly, concurrent audit. So these are the areas that you are required to see as an auditor, and you will be able to understand when you will be able to correlate it with the regulations. Any doubt with this? Any doubt? Yes, no? If no, then quickly tell me from where the CRR requirement is coming for the commercial banks. CRR requirement commercial banks. Which section is there? Very good. Section 18. Where is the requirement for the CRR for the scheduled banks? Very good. Section 42. Where is the requirement from where the basically if I talk about what are the requirements of the exclusion from the net demand and time liabilities for the CRR, what things you are required to exclude? Quickly, just give me summary. Yes, very good. Adjustment that we talk about, amount received but pending adjustments, amount received from the NABARD or any subsidy or additional funds for the bank. Equity, yes, very good. Equity. So these are the things you are required to exclude from the demand and time liabilities. When the demand and time liability position is required to be calculated for CRR, when you are required to calculate this position so that you can see that the CRR is being maintained, there is a period. What is that period? Very good. Fortnightly, every second Friday. Okay. Now, very important question. Which are the approved SLR securities? We discussed. Approved SLR securities. Yes, very good. Government securities. What else? So there are various securities, government securities, a list has been provided. Those are the securities that are required to be, maintained as a SLR. Okay. Primarily, they are the securities, government securities, cash, gold, government bonds, state government related something. So all those things are required to be maintained. Asset classification, same we saw. Advances, we saw. Okay. So this is something about the bank audit. I want you guys to read the chapter. Read the chapter, and on the basis of that, bring your doubts so that we can discuss the doubts in the next session. Your chapter 14, unit 1, unit 2, you need to read it, without which you cannot be, you will not be able to understand the chapter. That is very important because it is regulation driven. Okay. Any doubts before we close the session? No? If no doubts, then thank you guys. Thank you for participating in today's session. We will meet in next. Thank you. Thank you.